Welcome back to our intermediate financial accounting class. Over the last few segments, we've been focused on earnings per share. We've been talking about why it's important, how to calculate it, what has to show up on the financial statements, how all of the methods work to get us at least two EPS numbers, basic and diluted earnings per share. Once we were comfortable with those methods, we started looking into the journal entries to account for the dilutive securities that lead to that difference between basic and diluted EPS. We've talked about converting preferred stock, converting bonds, and in the last few segments, we've been focused on stock options, specifically employee stock options. We've already looked at equity options, and we had just started to look at liability options in our last segment. And before jumping into this segment, I asked you to do the journal entries to record Sally's 1,000 liability options. So let's walk through this together now that you've taken a stab at it. Step one is to calculate the fair value of the options. And again, it's the number of options times the fair value per option times the percentage earned. And in year two, Sally's still got 1,000 options. The fair value is now $4 per option, and she has now earned all of it because it was a 2-year vesting period. We're at the end of year two. So our value is $4,000, and I'm going to bring that right down here. And the step two calculation is how do I get from a credit of $750 to a credit of $4,000, and I would need a credit of $32.50. And once I know that number, I can jump right in to my journal entry, which is the fun part. So I wanted to hurry to that. Let's see. Step three is the journal entry. And just for the sake of labeling this right here, this is step two. We needed a credit to SARS liability, $32.50, and the other part of the entry is always to some form of compensation expense, executive salaries expense, wages expense, etc. This is the change in fair value of the SARS liability. Now, hopefully you feel really comfortable with that. That's the calculation that you got. We have one more year's worth to look at before Sally decides to exercise her options. So please pause it here. We now have a $1 value at the end of year three. Go ahead and do the necessary journal entry. Now that you've done the journal entry for year three, let's just briefly walk through it together, and then we can jump into how we record the exercise or use of these options. So step one, 1,000 options, $1 per option. She's earned it 100%. So $1,000 is what I want my SARS liability. So my step two down here, I'm going from 4,000 to 1,000. That means a debit of 3,000. So my journal entry will be a debit to SARS liability of $3,000, and compensation expense for the year will drop by $3,000 because I don't owe as much to these people anymore because the fair value has dropped significantly. Again, hopefully you feel really comfortable with that. These numbers match up with what you got. The hard part for a lot of students is this debit to the SARS liability. Nobody wants to record a reduction in the liability. We still owe them this fair value. And what really makes people uncomfortable is the compensation expense being credited. It just doesn't make sense. But remember, in the past, we recorded compensation expense that was really high. Now we think we over-recorded compensation expense. So it's okay to drop it now when we recorded it, we think, too high in the past. And that's the logic that we're using here. In the middle of year four, Sally decides she's going to use these options. So the fair value on March 31st, when she decides to exercise the options, is $250. The actual stock price is $12 per share. And the big thing to remember at the time of exercise is that we no longer use fair value. We want to use intrinsic value. Step four is to record the intrinsic value. And to do that, I take the market price minus the strike price times the number of options exercised. Now in this case, market price is up here. It's $12 per share. Strike price was $8 for Alice, but for Sally, it is $10. And we're going to assume that she uses all of these options. So to get to the intrinsic value, I have to get the SARS liability to this $2,000. So to get from 1,000 to 2,000, I need a credit of 1,000. So SARS liability, 1,000. And my debit, like always, will be the compensation expense. And this is record intrinsic value prior to exercise. Step 5 is to close the liability. Remember that what we're doing here is instead of saying, great, come in and buy these at 10, go sell them yourself for 12, and then get the $2,000, we're just going to give you the $2,000 and save you the trouble, which is what makes the SARS liability more compensation and less ownership. An equity option, we encourage them to buy the shares in the hopes that they will keep the shares and become owners. Here we have no pretense that they're going to keep the shares. So let's just give them the money and that'll be their compensation, and we'll both be good. Everybody will be happy. They get their extra money. I don't make them angry because they have to find the cash to buy the shares, and I keep my good employees. So let's start by closing the liability by giving them cash. So I'm going to debit my SARS liability, $2,000. That's going to close that out. And I give them the cash. This is the most common, is that people want the cash. And that's what our journal entry looks like. Now, the other option here is that Sally comes in and says, you know, I do want to own stock in the company, but I don't have $10,000 to buy 1,000 shares. Instead of giving me $2,000 in cash, why don't you give me $2,000 worth of stock? So let's take a look at how this journal entry changes if that's what we do. So first things first, the step 4 entry is the same. I have to get the SARS liability to intrinsic value before I satisfy it. What changes is what I do next, because I can't just credit cash. Now I've got to figure out how many shares of stock do I give her, and how does that break down into common stock and additional paid-in capital. So the first thing I need to do is figure out how many shares I can give her for this $2,000 that I owe her. So to do that, I take the SARS liability balance and I divide by the market price. So in this case, my SARS liability is $2,000. My market price is $12. If I divide that, I get 167, more or less. Now you notice we've rounded here. It doesn't come out to a nice even number of shares. A lot of companies, if it doesn't come out evenly, will round up. Remember, the idea is to compensate our employees and keep them happy. So it's usually worth that extra fraction of a share to keep them happy. But some companies will simply round, using traditional rounding rules. So if you're below 0.5, we round down. If you're above, we go up. It's up to the company and the policy they want to have. Now that I know how many shares I'm going to give to Sally, the next thing is to figure out how to break it down. So I need to put par value into the common stock account. So 167 times 3 is 501. And once I know this number, I'm ready to do my journal entry. So I'm going to debit my SARS liability, $2,000. That's the constant between giving them cash and giving them stock. I have to get rid of the SARS liability one way or another. Into the common stock account, I'm going to put that $501. That's the par value. And the rest goes into additional paid-in capital, common stock. Issued stock to settle liability options. And that's all there is to it. The big issue of a SARS liability is just knowing we're going to mark it to market value, and then to intrinsic value, and then close it. And the journal entry for closing changes a little bit between cash and common stock, but really it's a pretty basic process, as long as you remember market value until they use it, then intrinsic value. Now, the last thing we need to talk about is the difference between US GAAP and IFRS for stock-based compensation. We've already talked about the differences between US GAAP and IFRS for earnings per share. Really, there's not much of one. And there really aren't a lot of differences here either, just a couple of minor things. So first off, we call them employee stock options. They call it share-based compensation, not a big difference. Under IFRS, all employee options are treated as compensatory. Under US GAAP, you can have compensatory or non-compensatory. We didn't worry too much about that difference here and focus mostly on the compensatory idea, but be aware that there is this other classification, and if you need to use it, you'll need to look it up in the ASC database and get the rules. But under IFRS, we don't worry about it. They're all classified the same. Also under IFRS, the classification of equity versus liability option is based on what we think the employee will do. If we think they will buy shares, we call them equity. If we think they'll want the difference, we call it liability. Under US GAAP, you don't have that option. If you have agreed that the employees can choose to settle for the intrinsic value at the end, you must treat them as liability options. So IFRS is based on expected, US GAAP is based on possibility. If you have any possible obligation to give them the intrinsic value instead of just selling them the shares, then we call it a liability option and we record it that way. Under IFRS, we record payroll taxes on share-based compensation as they earn it. Under US GAAP, we don't record them until the options are exercised. Last change, deferred taxes are recognized as the options gain intrinsic value under IFRS. Under US GAAP, we recognize deferred taxes based on market value. So just a few slight differences between IFRS and US GAAP, mostly in the details. The basic methods and basic principles are the same, and that's really nice that we don't have to learn a bunch of differences, especially as we see more and more IFRS leaking into the US systems. Now with that, we're going to wrap up our discussion of earnings per share and dilutive securities. We've done a lot of fun stuff in this chapter, some really important things, getting real calculations for earnings per share, getting real values for diluted earnings per share, doing all of these fun journal entries, our first look at stock options, lots of cool stuff that hopefully you now feel comfortable with. As we come back, we're going to move away from the income statement and into our other sets of financial statements so that we can wrap up our discussion of these intermediate topics. We'll see you then. Thanks.